Hello and welcome. Thank you for joining us on Business Morning. I'm Chimeze Obi Iwagu. We begin on the global oil market as prices fell this morning as major producers warned of a risk to demand recovery if the coronavirus crisis is prolonged, while U.S. crude inventories dropped less than expected. Brent crude was down 36 cents at $45.01 a barrel, having slipped 0.2% in the previous session. U.S. oil was down 38 cents at $42.55 a barrel after inching higher on Wednesday. Stockpiles of crude in the United States fell for a fourth straight week, even as net imports rose. The Energy Information Administration said on Wednesday that stockpiles of crude in the United States fell a fourth straight week, even as net imports rose. However, the 1.6 million barrels decline for the week to August 14 was less than the expected, what was expected for 2.7 million barrels fall. The EIA data also showed fuel demand was down 14% from the year earlier over the last 4 weeks. In the meantime, the Organization of Petroleum Exporting Countries and its allies had a virtual meeting on Wednesday to review the compliance levels with the production measures embarked on last month, a move that aims to support prices and prop up revenues for member countries. Speaking at the meeting, the Saudi Energy Minister, while urging partners to comply with a deal to cut output, said global oil demand should recover to pre-pandemic levels as soon as the fourth quarter. For more on the outcome of the OPEC meeting, let's talk to Dr. Dero Fawibe, the Chairman, International Energy Services Limited. Thank you very much for joining us, Dr. Fawibe. Hello, Dr. Fawibe. All right, while we wait to get connected to Dr. Fawibe, let's look at what the development in the oil market would mean for investment in Nigeria. And I'm being joined by the head of portfolio management at Commercial Partners, Victor Aluyi. Good morning, Victor. Thank you for joining us.
Morning. Thanks for having me.
Now, with the outcome of the latest OPEC meeting and the uncertainty on the outlook for the oil market, how do you think portfolio investors should, react to this outcome?
Well, I think the outcome is something that was largely expected. The idea is that Nigeria, Angola, Iraq, and one or two other countries had not complied with the output cut that OPEC Plus had instituted in April to start in May. So clearly, in order to have a good level of compliance, as a matter of fact, to get to about 100% level of compliance, OPEC Plus wants those members that were previously non-compliant to essentially become compliant. At the meeting yesterday, part of the review showed that, the cuts have been compliant to as much as 97%. But OPEC Plus is pushing for 100% compliance. So for Nigeria, those cuts essentially meant that we should be producing about 1.4 million barrels a day starting in May. But apparently Nigeria had overshot that in May and in June as well. So Nigeria needs to make recompense between now and September to factor on those, excess production and also to be in line with cuts. So clearly, this would have implications for Nigeria's revenue. Obviously, as we know, crude oil accounts for a significant portion of the nation's revenue. So if you are having to produce less, so clearly you are producing lower because of the OPEC cuts, and then you're having to even compensate, for the overshooting that you have done over the last 2 months, it will certainly have implications. But again, it's just certainly likely to balance out because, you had overshot and now you're just basically compensating. But generally, it will have a negative impact on the nation's revenue, and by extension could cause some stress to the country's fiscal position.
Now, for the listed oil companies, would there be a cause for alarm in terms of impact on their bottom lines?
Well, I don't see any significant impact there. Recall or remember that most of the listed companies are essentially downstream players, except for Seplat, for instance. And if you look at Seplat, it's the gas component of the business accounts for more and continues to account for an increasing percentage of its total top line, and by extension, the impact that would have on bottom line. So I don't see any significant impacts. on the listed oil players.
Now, for more than 2 months now, we've seen stability in crude oil prices at around $40 to $45 per barrel. With this meeting, is Nigeria likely to see an improvement in foreign inflows?
Well, I think the question of foreign inflows isn't necessarily just limited to crude oil receipts. It also speaks to the desirability of Nigeria as an investment destination. If you look at the capital importation report for Q1, if you compare that to a year ago, it was down by about 3 billion. So the issue of foreign exchange inflows is not just limited to the receipts that we get from crude oil. Yes, the receipts from crude oil will be impacted negatively because of the output adjustments that we're going to see. But even more significantly, the issues or concerns around liquidity within the FX market will continue to weigh on investor sentiment and also weigh on the minds of investors looking to bring in, FX inflow into the country. So I think that's probably a more significant aspect of the spectrum.
Now, we know that the forex scarcity has led to difficulty of proceeds repatriation. What is likely to change if 97% of pre-pandemic oil demand returns during the fourth quarter, coupled with the World Bank's $1.5 billion loan we're waiting for?
Well, I mean, it's also important to point out here that we've got about 3.5 billion in April or so. That just basically served to support reserve position for about a month or so. The truth of the matter is that, reserve positions are at about 35 billion right now. There is likely to be a continuation of the strain that we have seen so far. Suffice it to mention that we have that significant backlog of FX demand that is waiting to go out, about 5 billion of that. You also have close to 7 billion of FX swaps that mature between now and the end of the year. So these are factors or variables that will continue to strain that reserve position and also continue to weigh on the nation's FX position. The steady movements in crude prices would help. It would support. But I think that there are more fundamental issues to be addressed with regards to FX. The 1.5 billion again would just help to assuage things in the near term. It will certainly not serve to bring about any medium to even long-term solution, in this issue. Is
there any alternative for the foreign portfolio investors that are stuck?
That's a really tough one. It's really tough. The truth of the matter is that they are going to have to continue to look, in the local environment, within the equities and the bond space to probably pick up bargains or pick up names where they think that there is value, while they basically bide their time and wait for the Apex Bank, to fulfill its promise of attending to their, dollar liquidity needs.
Now, we have seen some diversification efforts by government to the area of gas. An example is the AKK project. Just how much of all revenue loopholes can gas replace for Nigeria?
I think, speaking about potential for gas, it's enormous, it's huge. We have the gas master plan. There are a number of policy initiatives that have also been instituted in that area. The idea is to really, profitably tap, those gas reserves that we have to ensure that it helps to significantly shore up the nation's revenue. Truth of the matter is that in the near term, I don't know that we're going to see much traction there, but there is policy that is going on that would ensure that in the medium to long term, gas will begin to contribute even significantly more than it has in the past. And also recall that gas is also a very clean source of energy and will certainly remain in demand even as, the demand for fossil fuels starts to, plateau and decline over the next coming decade. So something significant should come from that.
All right, so how would this latest OPEC decision shape MPC decision at its next meeting?
I don't see any significant bearing on that MPC meeting. I think the CBN, the committee, would still be focused on its core mandate of essentially trying to stabilize prices both locally and internationally. So clearly, you're seeing inflation at about 12.8 to the latest figures we saw at the beginning of the week. I think the question remains as to At what point would the committee become worried or concerned about, inflation tearing away? Also, exchange rates remains a concern. So I think those are the issues that the central bank will be focused on. Those are the issues that the committee will certainly be looking at and trying to provide some sort of guidance as to, whatever policy initiatives they will be taking to try and assuage, the impact of those variables on the broad macro economy.
All right, thanks, Victor, for your time. Victor Alui
Thank
is
you
the
for having
head
me.
of, yeah, Victor Alui is the head of portfolio management at Commercial Partners. Now, for more on the outcome of the OPEC meeting, we'll now have Dr. Dero Fawibe to share his thoughts there. He's the chairman, International Energy Services. Good morning, Dr. Fawibe. Thank you for joining us.
Good morning.
Now, do you share same sentiment with Saudi Energy Minister that global oil demand would recover to pre-pandemic levels as soon as the fourth quarter?
Well, I think. Hello.
I can hear you, Dr. Fawibe.
Okay, could you repeat the question? I'm just hearing you now.
Yeah, do you share the same sentiment with the Saudi Energy Minister that global oil demand will recover to pre-pandemic levels as soon as the fourth quarter?
Well, it's very doubtful that the oil market will go back to the COVID-19 simply because it takes quite a while before the activities that prevailed before the COVID will go back to normal. We are now talking about near normal, and that will mean that some activities that were being carried out that generated demand for oil will not actually be there, very quickly. But one hope that, for the rest of this year, the demand for oil will be very sluggish, simply because there are still pandemics rapidly in the world, particularly in many countries like the United States and some parts of Europe. And even even China that has recovered remarkably, there is anxiety that the pandemic may have some resurgence. So, and this is the situation around the world, as you know too well. The sky is still free of aircraft because part of the demand for oil used to come from the airline aviation industry. And given the low level of flights all over the world, the demand in that area will be rather sluggish. And the same thing with the industry manufacturing sector that is using at a low edge in many countries. So these are the reasons why demand for oil will be low, at least for the rest of the year. But given the output cut by OPEC countries, I think the level of oil supply to the world probably relates to the level of activity that is currently taking place. We hope that next year demand will pick up due to increase in the demand for oil, and also we hope that there will be a vaccine either first quarter or before the middle of next year. These are the elements that will actually raise demand for oil, and the oil industry will come back. The price will go up to a reasonable level beyond this $42, $45 per barrel that we are currently having.
Now, Nigeria and Iraq were still called out at that meeting, urging them to do more to meet their quota. What's your take on that? Does it mean Nigeria has not complied fully yet, even when the Minister of State for Petroleum said Nigeria has?
Well, at the initial, after the agreement for production cutback, Nigeria was not actually responding very quickly. But the minister did say that Nigeria will fully comply, in course some time. So Nigeria was rather slow in complying with the agreement for the production cut. And if you took a different area for Iraq, Iraq has not, it has some difficulties. We know what is happening in Iraq due to the crisis there. In fact, we can hardly know the actual level of output from Iraq. I know OPEC and some other agencies are monitoring what is happening in various countries. So the level of compliance, by Iraq is rather low. And it's not only in respect to Iraq. The other countries like Kazakhstan, Brunei, and even Southern Sudan, their level of compliance with the production cost has not been in accordance with the agreement. But Nigeria, as a responsible member of OPEC, has actually tried to raise the level of compliance to about 86%, especially between May and June. And in the coming months, I know Nigeria will actually achieve close to 90% or 95% compliance.
Now, there was an earlier virtual meeting between Saudi Arabia's King Salman bin Abdulaziz and President Muhammadu Buhari. Any idea what that meeting was all about?
Well, the discussion, even though the discussion was not made public, but one can easily guess that the discussion between the two leaders is centered around the issue of compliance and encouragement, to actually make Nigeria to ramp up production or to cover production to the level as agreed. Now, Nigeria's situation has always had some level of understanding, particularly from Saudi Arabia, because we have serious issues here with respect to revenue, which is different from some other countries. Given the fact that Nigeria depends very much on the revenue from oil, notwithstanding the results or the progress we have made in diversification of the economy, especially in terms of agriculture and some other areas. But we have now had hit by a shortage of inflow of foreign exchange, which used to be generated by oil money flow. So I know Saudi Arabia is one country that can show remarkable understanding for Nigerian position, and given the position of Saudi Arabia in OPEC. But that does not mean Nigeria will not comply with the agreement reached at OPEC Plus meeting. So the discussion will certainly be for Nigeria to appeal to Saudi Arabia to show understanding, but at the same time encouraging Nigeria that we have to comply with the production cost, even the fact that we are a responsible member of OPEC. And the relationship between Nigeria and Saudi Arabia has been very cordial, over the years. Even when the current president was Minister for Petroleum, way back in the 1970s, Nigeria and Saudi Arabia has maintained very close relationship and collaboration. So I was not surprised to know that discussion actually took place, and I could easily project what could likely be the outcome and the meaning of the discussion between the two leaders.
Now, the meeting left output reductions unchanged. What is the implication of these OPEC decisions for oil servicing companies like yours and oil producers and explorationists?
Well, it's not only the level of production resulting from the production cost that affects the oil service companies. What we are having currently in Nigeria, yes, we have some of the oil companies suspending production or construction activities, especially for some critical projects. But the part of the reason for the lackluster performance of the major oil companies result from policy issues that they are having with Nigeria. And last year there was quite a bit of discussion going on between the Ministry of Petroleum, the Attorney General's office, and the oil companies. And some of these issues have not been actually concluded. And the issue of PID is also expanded. These are the issues that affected the performance of the oil companies. We've had some discussion with some of the IOCs, and they will tell us that, look, your government is not doing as much as they will expect, and they are not giving encouragement for investment in Nigeria. So if only we can get our act together, in terms of giving more changing some of the policies we are having, particularly the NCI bill.
Okay.
This will encourage the oil companies to do much more and affect the oil service company positively.
All right, thank you very much for your time, Dr. Diro Fawibe, the Chairman, CEO, International Energy Services Limited. Thank you for your time. We'll take a break, and when we come back, we'll look at the commodities market space. To stay with us. And for update on domestic commodities market, I'm being joined by Temitope Olubile, one of the research analysts with Financial Derivatives Company. Hello, Temitope. Good to see you again. Good morning.
Good morning, Chimeze.
Well, I'm sure you listened to Dr. Fawibe there, reeling out some of the challenges all services companies like them and producers are actually having in the oil and gas industry. And one of your burning economic issues this morning is saying that the rig count falls by approximately 70%. So what would this mean for investment?
Okay, so the first thing is to understand what the rig count really shows us. It's a leading indicator of, activities and investments in the oil and gas sector. So we see that the latest figure that we have for July, it was down 70% from the peak of 20 in 2019, and that's the lowest figure we've seen since February of 2017. So that shows us that, activities and investments are not, as they should be, in the oil and gas sector, and that, brings into context the petroleum industry bill that we hear should be submitted to the president. So, that would, help to drive investment in this sector, because you see that all servicing companies are, really bleeding cash in this period, and the pandemic has really affected the activities in that sector. And another angle we can look at this oil rig count data from is, we see that with this data, in the oil and gas industry, right, we have the rotational expats that come into the country, right, to help in, the rig activities. And we see that if the rig count is down by 70%, it means that expatriates are not really going to come in, right? And they have a huge function that they play in the market, because when they come in, they have the impact on the real estate, because you have to, give, short let apartments for them. So there'll be that impact on real estate. There'll be the impact on the hospitality services, hotels, restaurants. And, these sectors have already been affected by the pandemic. The fact that these expatriates won't or will not be coming in as frequently as they would have, would really have an impact on these sectors. And another thing is, when these expatriates come in, they're able to bring in the dollars, and right now we see that there's a huge demand gap in the forex market. So we have that would also have a negative impact on what we're already feeling, and they play a huge role for a consumption-led economy. 70% of our GDP is from consumption, so that impact will be felt in our consumption.
Now, with the recent outcome of the OPEC meeting, where we heard that Nigeria and Iraq again were called up for not meeting up with their production, cut. Of this production cutting and then having this recount, what would that imply for the country?
Because if you look at the meeting, we saw that the breakdown of the compliance level shows that Iraq has a higher compliance level than we actually have. I think the report showed 65% for Nigeria. And so it shows that we can be doing more, and we should be doing more. And OPEC is expecting 100% compliance. That's what they're going for. What they can really control is the supply to, rebalance the oil markets. And so we see that they're going for that 100% compliance level. And Nigeria, again, was mentioned. So it just shows that we have we have to do more. We are already doing it. We saw that oil production for July was about 1.49 million barrels per day. So, but we should be not, right now, I think the goal is not to even be at our quota. We should be doing less than our quota if we're trying to make up for the months that we were producing way above our quota.
No, but then what happens to, since we have oil revenue as our major, source of foreign exchange, then we have to cut our production. That's also
bad news.
Putting more pressure on foreign exchange market.
It is going to put more pressure, but the only succor we can have now is, oil prices are doing better than where we were as at March, April. We're about $45 per barrel now. We see that impact already playing into the FAC figures we got yesterday, showing that FAC actually increased by 3.8%. That is also because of the oil price, gradual pick up in oil price. So that should be our succor right now. And the what we can lose out from not complying with OPEC quota is that impact will be greater than what we're losing out from a lower oil production. So I think compliance should be our goal.
Now, do you also share the same optimism with the Saudi Arabia minister that oil demand, of course, is likely to improve by the fourth quarter?
I think it will be important to look at where does oil demand come from. I think one of the major sources and one of the major concerns is the aviation industry, right? Because, the demand for jet fuel. So you see that the recovery in the aviation space is not, IATA is projecting, I think, till 2024 for it to really pick up to where we were before the pandemic. So that aviation recovery is still slow, and so that I feel like would really impact on this oil demand recovery. I think it should be able to pick up gradually as economies reopen, but there will still be, because passenger traffic is still low, load factors across major air carriers is still not where they used to be. So I think it would really depend on aviation recovery, and I think it should recover gradually, but not to where we were before the pandemic.
Perhaps when they open more spaces,
yes,
for the airlines,
yes,
to fly.
Yes,
all right, let's look at the agri-commodities. You have the Cameroon suspending cocoa project land lease. What is the story behind this?
So the story behind is that Cameroon is doing a lot for its cocoa output right now, and news reports is even saying that they have displaced Nigeria as the third largest cocoa export producing country, and we see that cocoa is our largest non-oil export. So we need to keep our eyes on Cameroon. Cameroon is doing a lot, and the report basically shows that there were some land dispute issues, but what really piqued my attention was the land was 26,000 hectares of land, and we see that land was supposed to produce cocoa beans for a $92 million factory in Cameroon. So that just shows you the investments that the government is doing to boost its cocoa output. And right now, Cameroon is gradually displacing Nigeria. So it speaks to our export competitiveness. We have to be competitive in the quality of our cocoa output. And we see that our state governments are really trying. Cross River is doing what it can. Other state governments are picking up, but we really need to keep our eyes on Cameroon and improve our export competitiveness in price and in quality of our cocoa output.
Now, what would that mean for the global cocoa output and prices?
So I mean, with the increased demand for Cameroon cocoa outputs, we see that rally in cocoa prices now, that there's a pickup in cocoa prices, and that is good news for Nigeria in terms of what global prices, and we can benefit from that. But again, if more countries are demanding for Cameroon's cocoa output and not coming to yours, it speaks to the fact that Cameroon is really starting to displace Nigeria as a global leader.
All right, and another issue, tensions between Nigeria and Ghana seem to be, escalating, and this is ahead of the AfCFTA. This obviously is not a good news. It's not a good development.
It's not. It's not what we need right now. Both countries are, feeling a bit slighted in terms of, Nigerian businesses being closed in Ghana. Ghana, feeling that, we closed our land borders against them. Yeah. So there's all these
So you think part of the reason could be the fact that Nigeria closed the land border, because that's the speculation we're having there.
In Ghana,
that could be why they are attacking the Nigerians.
I mean, it can be, but it's important to understand the fundamental of closing the border. It was not. I don't think it was a personal attack against any country. It was just to protect our own space. We don't want a dumping ground kind of situation. We wanted to, protect our people from expired products. The land borders were porous. Expired products were coming into the markets, having an impact on our health. And, we were returning to be a dumping ground. And, there was that, disparity. And so it wasn't a personal attack. And I think, it's time we need to see ahead as soon as we get closer to the after implementation. We see what has happened with global supply chains. We see what is going to the shift in globalization that is going to take place after in a post-pandemic world. It would be more there will be more focus on integration within the African space, to hedge against risk of what we saw when global chains were disrupted. So there'll be more focus on African integration, and AFTA will be the first test of whether we're ready for this African integration or not.
No, but it's 1 year since the border, was closed, and we're talking about economic integration here. Shouldn't we be talking about perhaps reopening the borders?
I mean, at the first, when we closed the borders first, it was because of, the porous land space. But now, as the pandemic entered, it kind of shifted, in my own opinion, to, protecting our people, to, airspaces were closed, so why not land borders closed to prevent the spread of the virus. So I think, it was now that double effect and double reason for closing the borders. But, as we start to open domestic airports, international airports, once we're able to clamp down on the porous land borders, once we're able to get the security that we need to be able to prevent just any good from entering our country, I think we can start to look into the opening of the land borders, especially as that will not help in the free trade that we want when after it kicks in. So we need to start looking into that.
Now, do you think what is happening now presently between Nigeria and Ghana would have any implications for Nigeria-Ghana trade relations?
It could, because, we see that, first of all, the Ghana was already, being more attractive to our Nigerian businesses because our business environment was not friendly, and why not go to somewhere that is just close by? So there was that already, there was that competition. So as the tensions escalate, it could have an impact on trade relations, and Ghana is, our sub-Saharan African peer, and they're so close to us. There's so much to be gained by a friendly relationship between these two countries, because it's just how many hours away free flow of goods can happen between these two countries. So now is not the time for a trade clash between these two countries.
Absolutely. All right, let's look at your domestic commodity price movement there. Can you take us through what has the week been like on that space, and what's the outlook?
Okay, so we see that in the last week, yam and pepper, the prices have declined because owing to early harvest of these commodities. But something that was interesting was the flour, because we saw that flour price has increased to 13,000 naira for a 50 kg bag. But that's because of the exchange rate pass through. But what we're thinking is as flour increases, bread prices might also tend to increase, and when that happens, there will be what we call cross elasticity of demand. Consumers will likely shift to other substitutes of bread, and so when there's that lower demand for bread, flour prices can't stay high, because bread makers are contribute a significant portion of the demand for flour. So we think that flour prices will start to come down when bread makers see that consumers are shifting their demand to other commodities, other substitutes, and we see that price will likely to come down in the coming weeks.
All right, thank you very much for your time.
Thank you very much.
Temitope is one of the research analysts with Financial Derivatives Company. We'll take a moment. We'll be back.
What? Now this is more like it, right? We want the best quality ingredients when we cook. But when it comes to salt, we care less. We say salt is salt. Well, I care about my salt. It goes into my food and my body. So I use Dangote salt. Dangote salt is high-quality salt that is refined and iodized to give great taste to my meals and also to support my family's health and well-being. It's time to care about your salt.
And for review of Wednesday's equities trading and outlook, we have Temple Ashaju. Well, gradual but fragile recovery. Temple.
I love that phrase. Yesterday we used the phrase seemingly bullish. We're not too sure what direction the market is heading to, but we know that some smart folks are actually making money. They're cashing out and of course checking out what is available in other aspects of the capital market, whether on the debt side of things or on the unlisted security space. But basically we got a 14 basis points appreciation yesterday thanks to the interest in Zenith Bank, GT Bank, Access Bank, UBA, the four 4 tier 1 banks as investors continue to cherry pick in anticipation of some kind of interim dividends in the market. Basically, we added some 2.2 billion naira to the equity capitalization yesterday, so we still remain at this status, 13.13 trillion naira. And of course, look at the volume, basically the activity level was not so good yesterday. We got a decline by some 30-something percent, 38% decline in value. But if you look at what Zenith Bank actually contributed to this, it was some 36 million units of Zenith Bank's shares traded for over 605 million naira. Eventually, we saw an appreciation of some 0.90% in Zenith Bank, and that contributed more to what we have in this space. The 605 million naira from Zenith Bank only added to the number that we have. I mean, if you take that away from the 1.53 billion naira worth of transactions that we saw value yesterday, it accounts for around some 40% eventually. Deals 3,108. Let's look at the sectoral performance of the market. Banking stocks, I told you, tier 1 names basically all performed well, excellently yesterday. If you're one of those that had Zenith Bank at 14 naira, you might be checking now. You've got some 2 to 3 naira exit position at this point in time. So don't waste no time, because if you wait for too long, you never can say, you might get your fingers burned. So check that again. You got UBA rising higher. You got Access Bank very positive. Jais Bank is one company that has actually been crawling lately upwards. That's an area that you might want to look out. Consumer goods side of the market yesterday, suddenly we saw an interest in international breweries. This is a consumer good, a major brewer in the market that had been trading at some 33 naira per stock, per share before now. Now it has fallen to some 2 naira 90 something kobo. Yesterday was around 3 naira. So some folks checked it out and it gained some 7 naira 14 kobo. Now if you look at the industrial goods stocks yesterday, CAP led some 12 other companies to actually fall yesterday. It was down by 10% eventually, and we know that we had 5.75 million units of its shares traded yesterday in the market. That then widens the year-to-date performance to some 36.52%. Now, it ended trading at 15 naira 32 kobo. That's something that you might want to look at, because at the end of the day, the negative position that we saw on this particular company impacted the sectoral performance here, which settled at 0.04%. Now, insurance space, mutual benefits was positive. Since the release of the recapitalization guidelines for companies by NICOM, that will be National Insurance Commission, we've been seeing some activities on this particular sector. This is one very, very deceptive sector actually, because when it moves in a very positive direction most of the time, but then opportunities for profit taking also abounds in this space. Oil and gas was flat yesterday, was unchanged in spite of the fact that we got some gains across Japan. But look at Adova PLC, it's back down to 12 naira 60 kobo. Cornwell, since the profit taking of 10% that we saw in the last 2 sessions, is remained at 15 naira 25 kobo. It might be time to do some valuations on these companies. O&O is back down to 2 naira 24 kobo. Used to hit 2 naira 60 kobo. You might want to check that out as well. But look at this. Seplat yesterday had no movement. Total had no movement. Eternal PLC, no movement. Japal was up yesterday by 5%. Moved all the way from 20 kobo back up to 21 kobo. Not so much of difference actually, but you might want to check that out as well if you do your valuations very well. Let's look at the unlisted side of the market. 15 basis points negative yesterday. That's some serious profit taking that we saw on this space. Yesterday, look at, we got some 761,395 units of shares traded in total on this space yesterday. Now we know that CSCS, which is the Central Securities Clearing System, had more of the trading there. 50,000 units of its shares constituted what we have here. Then we had WAMCO yesterday, which had some 500,000, 100 or thereabout, over 500,000 units of its shares traded there yesterday. Had opened at 120 naira per share, and it closed at 120 naira 10 kobo. It added 10 kobo eventually. You have a couple of other companies that also performed here. UBN Properties, yes, I recall now. UBN Properties also had some transactions there yesterday, and it also recorded some gains because it's also opened at 1 naira 20 kobo and closed at 1 naira 26 kobo eventually. So in total, we had some 61 61.04 million naira worth of transactions on this space yesterday. 8 deals in total. Yes, 2 of the deals went to CSCS, and of course 4 of the deals went to your milk maker, Wamco. Then you had 2 other deals coming from UBN Properties. Now, investors have been watching this space critically. We had seen a situation where the market capitalization rose to as high as 527 point something billion naira, and of course some kind of profit taking sets in. Eventually the profit taking that we saw then reduced the performance to this level. But then again, we know that this segment of the market has actually been enjoying some performance since we saw some kind of shaky performance on the equity space. Then investors move down here. Chimeze.
Thank you, Temple. Well, I'm watching this equity market with my third eye. I'm sure you know what I mean. We'll take a break. When we come back, we'll do an opening call to London and then get back to you, Temple. Let's now talk to Simon for updates from the streets of London. Good morning, Simon.
Good morning.
Yeah, well, the Fed has unnerved investors by expressing significant concern about the impact of COVID-19 on the U.S. economy. Are investors in the U.K. unnerved also by this statement as well? How are the markets responding this morning?
In a word, yes, they are worried. Fed officials agreed that the ongoing public health crisis would weigh heavily on economic activity, employment and inflation, and was posing considerable risk to the economic outlook over the medium term. Fed leaders have emphasized multiple times the need for more fiscal help from Congress, which went into recess without a deal for more rescue funding, even as critical elements such as enhanced unemployment insurance expired. Members are in favor of adding clarity to their expectations for when they will hike rates again. They appeared to reject the likelihood of using bond purchases to control yields on government bonds. Stocks gave up some gains after the minutes release this morning, while yields edged lower and the US dollar rose slightly. After this news, European markets, including the FTSE, all slid at the opening bell this morning. The FTSE 100 index opened firmly in negative territory over the apparent inability of senior politicians in the US to agree on additional stimulus packages. General consensus is that very little clarity was provided by the Federal Reserve's rate-setting committee's meeting, minutes from which published last night left traders a little bit bemused, to be honest. All we really got were 2 paragraphs that basically said they were still discussing things. Markets also not helped today by HSBC, the bank saying they expect the economy to shrink by 10.3% in 2020. That's a lot worse than they'd previously predicted. It's also not helped by a spike in new European Union coronavirus cases. So yeah, generally the markets here not looking great today.
And talking about corporate news there, British Gas faces the threat of a strike after workers voted overwhelmingly in favor of industrial action in response to the energy giant's fire and rehire plans. How is the company responding to this planned strike by the workers?
Yeah, so this is more than 2/3 of GMB's 10,000 union members who took part in the ballot, and they secured a 95% majority in favour of striking, so pretty overwhelming. The vote shows the tensions between Britain's largest energy supplier and union representatives, who have accused British Gas of forcing its 20,000 employees to accept worse employment contracts or lose their jobs. The owner of British Gas has been in talks with unions to simplify the employment contracts it uses across its workforce, alongside plans to cut 5,000 jobs to help the company survive the impact of the pandemic. The company has promised employees they would only seek to terminate existing contracts and then offer fresh terms, known as a Section 188 notice, as a last resort. That's known colloquially as fire and rehire contracts. But GMB, the union, said the company had already burned through the confidence of its loyal workforce by threatening to set fire to jobs, terms and conditions. The head of the union says this demonstrates GMB members are not prepared to tolerate fire and rehire threats, and called on the company to listen and to get real. So yeah, if there's a strike, then British Gas are going to be really struggling, I think, because they are Britain's main energy supplier, and yeah, who knows what that means for the consumer if that does go ahead.
Now, Simon, you talked about Marriott yesterday. The hotel group is facing a class action lawsuit in London's High Court for millions of customers who are seeking compensation after their personal details were stolen in one of the world's largest data breaches. What is the latest on this, and how is the stock reacting?
Yeah, so Marriott is the world's biggest hotel company. It has lots of brands under it, including Bulgari and Westin, and it's facing a class action lawsuit, as you said, which could cost it £1.75 billion following that data breach affecting hundreds of millions of guests. Marriott International is being sued for a cyber attack that affected the company's Starwood Hotels business between July 2014 and September 2018. It stands accused of breaching the EU's tough general data protection regulations known as GDPR. The lawsuit claims Marriott failed to take adequate technical or organizational measures to ensure the security of guests' personal data and to prevent unauthorized and unlawful processing of that data. Well, the share price is down at the moment 0.47%, but the share price has dropped significantly since the data breach was revealed. It's currently $9 a share, but it was $150 per share in December last year. That's a 36% drop in value in just a year. Also suffering heavily from the pandemic, revenues plunged 81% in Q2 of this year. So generally as a group, it's not looking great, not only with bookings massively down because no one's traveling, but also this looming lawsuit. And it was basically brought about by one man, one journalist who decided that he was going to sue Marriott's on behalf of everyone, so he's the person who's gone to court, and there are millions of customers that could get compensation for that data breach. So it could be a huge cost for Marriott International, who are already in debt, by the way, in billions of pounds.
All right, we'll look forward to more updates from you later in the day, Simon.
Thank you.
And back here, we still have Temple for the debt and currency market.
Thank you, Chimezie. And back here, we still have the numbers waiting for you to digest. So yesterday, we saw the bond space experiencing some kind of paucity, because again we had the DM, or the debt management office, actually offering some 150 billion naira an auction to dealers and traders in the market, and that was greeted by over 92 billion naira worth of a subscription in the market. So generally on the secondary side of the market here, we got some 41 deals. That's beside other numbers, other papers that got traded. Investors checked more the shorter end of the curve, because again the longer end of the curve enjoyed some kind of bids at the auction yesterday. But generally we had 31.71 billion naira worth of transactions at the secondary space yesterday. Today we do hope that investors who were unable to actually meet the transaction or participate in the transaction of yesterday, the auction of yesterday, will come back to the secondary side of the market. Look at the NCB space, the treasury bill space here. Yesterday we know that the 29th of July 2021 paper specifically was on offer all through, but no demand. But other parts of the markets, there was no change in terms of yield here now. The July 2021 paper was actually offered at some 2.9%, no demand eventually. In total, we got some 16 deals, no billions of naira worth of exchange here. It was all in millions, and the entire value, when you put all this together, coupled with other transactions that we saw, was just 1.04 billion naira. Look at the open market operations pace. Now we know that some maturities are coming in today, and that's something that we know that the regulators and of course key players in the market have been pricing into their offers in the market. So generally here yesterday we know that investors had just 11 deals, and again we had just 12 billion naira worth of transactions. We have joining us on phone now Kaya Ewebi, a fixed income dealer with FSDH Merchant Bank. Kaya, can you quickly talk us through the stop rates and performance of the auction yesterday, the bond auction yesterday? We understand it had some 92 billion naira worth of transactions, or oversubscription rather.
Okay, thank you, Kempe. The DMO offered a total of 150 billion across the 2026, 2035, 2045 and 2050 papers at the SGN bond auction yesterday, but eventually sold 116.65 billion.
True.
Stop rates printed lower across the 15-year, 25-year and 30-year papers. The 10-year paper closed higher by 70 basis points. They sold 25.42 billion on the 2026 at 6.7%, 21.45 billion on the 2035 at 9.25%, 15.09 billion on the 2045 to close at 9.75%, while 53.69 billion was sold on the 2050 and the stock rate closed at 9.9%.
So generally the stop rates kind of reduced across the three papers, but then you saw kind of an increase on the 5-year paper. But why is the DMO no longer selling full volume? Is that in a bid to manage the cost of the budget implementation?
Yes, with the outcome, I mean, the DMO just reiterated its preference for cheaper funds. You know, they had the opportunity of selling the full volumes on offer yesterday, but decided to sell less than the amount offered, you know, to reduce the cost of borrowing. And also, we expect that given the liquidity that will be coming into the system in the coming weeks, home maturities, bank coupon payments, the DMO is also positioning itself to take advantage of this elevated liquidity level, you know, by borrowing cheaper in the market, and yields are expected to remain depressed for the foreseeable future.
All right, thank you so much for that analysis and that insight on the sales of the bond auction yesterday. We appreciate them. Keye Webiyi is a fixed income dealer with FSDH Merchant Bank, and we know that yesterday we had some improvement in the volume of transactions at the investors and exporters window. That's the FX space, NAFX. We had some 1,100% worth of transactions yesterday. That's like the highest in the last 8 weeks of the market. We had $227 million. We do hope that that will trickle into the real sector and bring about some change. Chimeze, over to you.
And not just in the real sector, in the FX market as well, Temple.
Absolutely.
Okay. We draw the curtain on today's edition of the program. Thank you for watching. I'm Chimeze Obi Iwago.